You do need to pay attention to a few details. IRAs, like all tax shelters, have rules you have to follow. They aren't very hard, but they do change now and again. They boil down to income restrictions, contribution limits, and withdrawal terms. For a traditional IRA, the income restrictions are pretty messy. They depend on whether you're covered by an employee retirement plan, such as a 401k, and whether you file as a single or married taxpayer. What's more, these income limits can and do change almost every year. For example, if you filed your taxes as married filing jointly in 2006, then the income limit for deducting your entire contribution was $75,000. At that point, the deductibility began to phase out until it vanished completely at $85,000. By 2013, the income limits had increased to $95,000 and $115,000. If your filing status is single, then those limits tended to be about 30% or 40% lower. Those income limits apply to what the IRS calls modified adjusted gross income. Your modified adjusted gross income comes from a line on your tax return. Essentially, it consists of money you've earned as wages, tips, salaries, bonuses, and the like. For a Roth in 2011, the income limits were $107,000 for people who filed as single, head of household, or married filing separately. Above that, the contribution limits begin to bite. The IRS reduces the allowable contribution as your income increases, and above $122,000, direct contributions to a Roth account were forbidden. For those filing jointly, the limits were about $50,000 higher. Roth limits can change too, so be sure you check before you make your contribution. Contribution limits tend to creep up with time too. In 2012, your combined contributions to your traditional and Roth IRAs couldn't exceed $5,000. By 2013, they were up to $5,500. There's a catch-up provision too. If you're 50 or more, then you can sock away an extra $1,000. For most people, the tax saving on that kind of investment can be pretty big over time. Remember the example we did earlier today? The tax saving on an annual contribution of just $750 was about $15,000 over 30 years. There are also time limits. I think of them as windows of opportunity. People whose tax year matches the calendar year, that's most of us, can make their Roth contributions any time from the beginning of the tax year through April 15th. Once the deadline for filing your taxes passes, though, you're out of luck. Even filing for an extension on your taxes won't let you dodge this restriction. When you withdraw your money from your IRA, you're taking a distribution. With a traditional IRA, you defer taxes until you withdraw the money. The rules for distribution depend on your age. If you're less than 59 and a half years old, then you'll pay the federal and state taxes, of course, but you'll also pay a 10% penalty. You can avoid the penalty on early distributions under certain circumstances. For example, first-time home buyers are usually okay up to a limit of $10,000, as are certain education expenses. Disability or death allows you or your heirs to tap the funds without penalty, as do unreimbursed medical expenses. Withdrawal rules for traditional IRAs get easier after you turn 59 and a half. You won't pay a penalty when you take a distribution. You'll pay federal and state taxes if you do, of course. You only get your tax break on the front end of a traditional IRA. Qualified distributions from a Roth IRA are simpler. With a Roth, you want to remember two numbers when it comes time to withdraw your funds. The first number is 5. That's the number of years it takes to season an account, making it eligible for favorable distribution rules covering Roths. That's a powerful incentive to open your Roth soon, even if you just invest $100. Get a start on that seasoning period as soon as you can. The second number is